Hey everyone, Longacres Finance here with a new series talking about simple retirement allocations for anyone to implement into their 401k, IRA, or taxable retirement accounts. I'll show you a few simple approaches you can use to either start or modify your current retirement strategy. Don't be fooled by the word simple. Just because they are simple doesn't mean they are inferior to more complex allocations. Rather the opposite. There are advantages to having a simple allocation, like ease of implementation, and they're easy to understand. It's important that you understand the components of your allocation. It'll give you peace of mind when the news are forecasting chaos in the market and economy. If you're new to the channel, don't forget to subscribe and hit the like button before you leave. Alright, let's get going. What you are seeing here is the current year, 2020, returns for the allocations I intend to discuss, updated through September month end. Let's quickly go over the strategies and then we will dig in deeper. The first 10 strategies are target date funds, each ending in a different year. The next 3 strategies are popular broad market strategies. We have the total stock market, the total bond market, and the large cap growth fund. The next section is a blend of total stock market and total bond market, starting with more risk at an 80-20 blend and getting less riskier as you move down to the 20 and 80 blend. The last section is similar to the previous with the additional inclusion of the large cap growth component to increase the expected return, but it also comes with additional risk. The first part we're going to look at are target retirement funds. These investment vehicles are the absolute most hands-off approach an investor can take. The only decision a person needs to make is which fund best meets their situation, and from there it's all on autopilot, forever. The target retirement funds are identified by the year you expect to retire and are offered in 5-year increments. All you need to do is choose the fund that most closely correlates with the year you anticipate to retire. The fund then sets your allocation accordingly with the time frame left before your retirement and modifies that allocation over time to expose you to more risk early on and reduce that risk as you get closer to retirement. The target date funds you are seeing here are those offered by Vanguard. Over on the right, you can see their ticker symbols and the cost of each of these funds. This cost is the annual cost, and you can also see the total cost on a $10,000 investment. Your 401k and IRA may offer target date funds from a different provider, but they all work in the same general manner. You want to review the costs and historical performance to make sure you aren't paying too much for the service and are achieving average industry returns. Let's take a quick look at a description of Vanguard's target retirement funds. Vanguard target retirement funds offer a diversified portfolio within a single fund that adjusts its underlying asset mix over time. The funds provide broad diversification while incrementally decreasing exposure to stocks and increasing exposure to bonds as each fund's target retirement date approaches. The funds continue to adjust for approximately 7 years after that date until their allocations matched that of the target retirement income fund. Investors in the funds should be able to tolerate the risks that come from the volatility of the stock and bond markets. You may wish to consider this fund if you're planning to retire between 2048 and 2052. And here we're looking at the Vanguard Target Retirement Fund 2050. If you would like to have more control over your retirement allocation, you can do so by utilizing broad market strategies and still keep the overall allocation pretty simple. Let's start with the Total Stock Market Fund. Vanguard's Total Stock Market Index Fund was created in 1992, and it's designed to provide investors with exposure to the entire U.S. equity market, including small, mid, large cap growth, and value stocks. The fund's key attributes are its low cost, broad diversification, and the potential for tax efficiency. Investors looking for a low-cost way to gain broad exposure to the U.S. stock market who are willing to accept the volatility that comes with stock market investing may wish to consider this fund as either a core equity holding or your only domestic stock fund. Vanguard's Total Bond Market Fund is designed to provide broad exposure to U.S. investment-grade bonds. Reflecting this goal, the fund invests in U.S. Treasuries and mortgage-backed securities of all maturities, short, intermediate, and long-term issues. As with other bond funds, one of the risks of the fund is that increases in interest rates may cause the price of the bonds in the portfolio to decrease, pricing the fund's net asset value lower. Because the fund invests in several segments and maturities of the fixed income market, investors may consider the fund their core bond holding. Vanguard's Large Cap Growth Fund seeks to track the performance of the CRSP US Large Cap Growth Index. It provides a convenient way to match the performance of many of the nation's largest growth stocks, and it follows a passively managed full replication approach. Looking at the cost of these funds on the right, we can see that they are significantly cheaper than the already cheap target date funds. The cost is about 1/3 of the target date fund. When you look at the annual cost of having $10,000 invested, it may not seem like a very large difference, but as your account grows, that dollar amount difference will increase. And over time, that difference can amount to $10,000 or $20,000 saved in fees that could have otherwise been invested and grown in value. With the target date fund, you are paying a premium for the service you receive. If you're unsure which option is better for you, consider if you are willing to spend time each year rebalancing your portfolio and adjusting the risk exposure of your portfolio. It doesn't require much work, but for someone who doesn't want to do that themselves or doesn't feel comfortable adjusting their own allocation, the target date fund premium cost is worth the service you receive. Allocating 100% to stocks may overexpose your portfolio to risk, while allocating 100% to bonds may result in missing potential growth. This is specific to each person, with no one right or wrong allocation for everyone. Think of yourself as a risk manager versus an investor for a second. Instead of focusing on trying to grow your portfolio as much as you possibly can, focus on managing your risk exposure. We know that investing carries risk, and historically stocks provide higher returns over bonds, but expose you to more risk than bonds. By risk, I mean the drawdown during recessions and market crashes. While most investments decline during recessions, historically bonds decline less than stocks, thus offering less exposure to risk. There are two primary things you want to consider when assessing your risk tolerance. One is your age and expected retirement time frame. The other is your level of comfort riding the ups and downs of the market. The latter is more difficult to determine because you don't really know until you experience it. If you are younger and have a high level of comfort waiting out market crashes, you can take a considerable amount of risk with your investments. On the flip side, if you are getting closer to retirement, or find that you're having anxiety seeing your portfolio decline, you shouldn't take too much risk with your investments. Here I will show you how 4 common blends of the total stock market and total bond market have performed this year and historically. An easy way to implement this blended approach in your portfolio is to start with 100% allocation to the total stock market if you are in your 20s or early 30s and have a high tolerance for risk. If your tolerance isn't that high, you can start with the 80-20 allocation. As you get older, you work down the allocation table, reducing your risk. How often and how much you reduce your risk depends on which allocation you want to end up with when you retire. If you have a high risk tolerance and maybe you have other sources of income during retirement, the 60-40 allocation may be right for you. In this case, if you start with 100% allocated to stocks, sometime in the midpoint between when you start and your anticipated retirement date, you would change your allocation to the 80-20 blend. You could also split that time frame into 4 time periods and go to a 90-10 blend, then 80-20 blend, and then 70-30 and end with a 60-40. If you will highly depend on your portfolio during retirement and have a lower risk tolerance, the 40-60 or 20-80 blend may be better for you. Over time, you're giving up some potential returns, but in return you get peace of mind that when you need your retirement funds, they are likely to be there. Before we talk about the 2020 performance and historical performance, let's discuss one more concept incorporating the large cap growth fund to potentially generate higher returns. These strategies are exactly the same as the ones we just discussed with the inclusion of the large cap growth fund. You can see the stock exposure for each blend is the same. We are simply reducing the total stock market fund allocation in lieu of the large cap growth fund. Historically, growth funds have provided higher returns, but carry more risk than the broad market. In September, the only positive strategy in our review was the total bond market with an 8 basis point return. The total stock market fund was down 3.56% and the large cap growth fund was down 4.72%. This is a good example of risk management. Stocks were down for the month, exposing investors to more risk, and bonds offered a safe harbor to protect your investments. The target date funds all had a negative return during September. The funds with a closer target date lost less during the month than the funds with target dates further out in the future. This shows you how they work. If your retirement date is close, the target date funds offer you some level of downside protection versus target date funds with longer time frames that expose you to more risk. Same goes for our blended total stock market and total bond market strategies. The allocations with more stock exposure perform poorer compared to less risky blends with higher bond allocations. The blended strategies that include the growth fund perform poorer compared to the blended strategies without the growth fund. If we look at the year-to-date performance, we can see that the large cap growth fund has significantly outperformed the total stock market, total bond market, and all the target date funds. It weathered the coronavirus market meltdown quite well in comparison to the total stock market fund and has bounced back quite strong. The total bond market fund is outperforming the total stock market fund by about 1.5%. And you can see that it wasn't really affected by the coronavirus market crash, yielding a positive return in February and only being down about 0.5% during March. The total stock market and total bond market blended strategies are performing well for the year. with the more conservative blends offering some advantage. The 40-60 and 20-80 blends are actually outperforming the total stock market and the total bond market funds for the year. The blended strategies that include the growth component are doing even better, with the 80-20 blend leading the year at just above 16%. Let's move on and take a look at the historical performance of our strategies. To quickly run through the last 10 years, we can see that 2019 was a very good year, 2018 was pretty poor, 2017 was a good year, 2016 was okay, 2015 was quite poor, 2014 was a good year, 2013 was a very good year, 2012 was a good year, and 2011 was a pretty poor year. You can see the majority of the best and worst performing strategies are the large cap growth fund and the total bond market during the last 10 years, with a few occasions where the target date funds performed the worst. One factor that I haven't mentioned yet is that the target date funds include an international component that isn't incorporated into our 2 and 3 fund blends. This is why they sometimes underperform or overperform the US only stock and bond funds. Over the last 10 years, US stocks and bonds have outperformed international stocks and bonds. Therefore, I decided not to include them in our strategies. If you are looking for more diversification and would like to include international exposure in your portfolio, Vanguard offers a total international stock market fund and a total international bond market fund. You can get more information on each on their website. Going back to the 10-year historical returns, the large cap growth fund has really outperformed the other strategies here, averaging over 15% on an annualized basis. The total stock market fund also averaged pretty solid returns, just north of 12% on an annualized basis. The total bond fund has had a quite poor 10 years, returning a little less than 4% per year on average. The target date funds, while not all have existed for the full 10 years, have averaged quite respectable returns in the 7 to 8.5% range. The interesting thing to look at here is how our blended strategies have performed. The riskier 80-20 blends have both averaged double-digit returns, which is very good. The 60-40 blends both outperformed all the target date funds over the last 10 years. This is somewhat interesting since some of the target date funds had a higher stock allocation during that time. The US-only allocation was the differentiating factor here. The 40-60 blends achieved respectable annualized returns north of 7%, and the 20-80 blends both clock in at around 5.5%. For a pretty conservative allocation, that is quite a high return. I wouldn't expect to see such a high return continue over the next decade. In the last column here, you can see how much a $10,000 investment would have grown over the last 10 years. If you invested $10,000 into the large cap growth fund, it would multiply to around $42,000 over the last 10 years. Not bad, a 4-time multiple. The target date funds would slightly more than double your original investment, and the blended strategies would offer between a 1.7 to a 3.1 multiplier, depending on the allocation you chose. That's it. Thanks for watching the video. Please subscribe to my channel for more videos. I hope you learned something here that you can apply in your personal life. See you next month for another update.